every major news network is covering the Iran conflict right now. The strikes, the countermeasures, the diplomatic back and forth, the oil price moves, and almost none of them are asking the question that actually matters, not will the war escalate, not what happens to oil prices. Those are the obvious questions, the question hiding underneath all of it. The question that has kept American financial strategists awake since 1974 is this: what happens to the dollar if the Strait of Hormuz closes? 20% of the world's oil supply passes through that narrow waterway every single day, and for 50 years the security of that waterway has been the hidden foundation of a financial arrangement so consequential, so deeply embedded in the architecture of global power that most Americans have never heard of it. It's called the Petrodollar system, and right now, for the first time in its 50-year history, it is under direct military threat. To understand why the Strait of Hormuz matters to the dollar, you have to go back to the summer of 1971, because that's when the United States created a problem so large, so structurally threatening to American power, that it required one of the most consequential secret diplomatic arrangements in modern history to solve it. On August 15, 1971, President Richard Nixon went on television and announced what became known as the Nixon shock. The United States would no longer exchange dollars for gold. The Bretton Woods system, the post-war monetary architecture in which every currency was pegged to the dollar and the dollar was pegged to gold at $35 per ounce, was over. Nixon framed this as a temporary measure. He was wrong on the temporary part. What he had actually done was destroy the mechanism that had given the dollar its global credibility for 27 years. Under Bretton Woods, foreign central banks held dollars because they could exchange them for gold. The dollar's value was not just a matter of confidence, it was a contractual promise backed by a hard asset. When Nixon closed the gold window, that promise evaporated. Overnight, the dollar became a fiat currency backed by nothing except confidence in American economic management and American institutional stability. The immediate reaction in currency markets was exactly what you would expect. The dollar fell, other currencies rose. Foreign governments that had accumulated dollar reserves found themselves holding assets whose value was now purely a matter of American political will. For the dollar to survive as the world's reserve currency, for American financial dominance to continue without the gold anchor, the United States needed a new mechanism, a new reason for the world to demand dollars, a new structural arrangement that would create permanent, inescapable, global demand for the currency that America could print. Henry Kissinger, then serving simultaneously as National Security Advisor and Secretary of State, understood this with exceptional clarity, and Secretary of State understood this with exceptional clarity. And in 1974, he built the solution. The timing was perfect, in the grimly opportunistic way that great power diplomacy often works. In October 1973, the Arab members of OPEC had launched an oil embargo against the United States in retaliation for American support of Israel during the Yom Kippur War. Oil prices quadrupled almost overnight. Americans sat in lines stretching around city blocks waiting to fill their gas tanks. The economic damage was severe. The geopolitical humiliation was worse. But Kissinger saw something else in the crisis, an opportunity. Saudi Arabia was the dominant force within OPEC. Saudi Arabia was also deeply anxious about its own security. Threatened, the Saudis needed an American security guarantee. They needed weapons, they needed diplomatic protection. And America needed something very specific from Saudi Arabia, a commitment to price oil in dollars and only in dollars. Suddenly, every country in the world that needed oil, which meant every country in the world, needed dollars. Not as a matter of preference or confidence, but as a matter of structural necessity. You couldn't buy oil without dollars, which meant you couldn't run a modern industrial economy without accumulating dollar reserves, which meant the entire global economy had become, in a very real sense, a permanent customer for American currency. The dollar had lost its gold anchor instead, and an energy anchor instead was in some ways more powerful than gold, because unlike gold was in some ways more powerful than gold, because unlike gold, which just sat in vaults while was consumed every single day. By every country on earth, this was the architecture Kissinger built. This is what has sustained dollar dominance for 50 years. And this is what the Strait of Hormuz right now is threatening. The Strait of Hormuz is 21 miles wide at its narrowest point. It sits between Iran to the north and the Sultanate of Oman to the south. Through it passes the oil of Saudi Arabia, the UAE, Kuwait, Iraq, and Qatar, roughly 17 to 20 million barrels per day, depending on production levels. That is approximately 20% of all the oil consumed by the entire world. There's no alternative. There's no pipeline, no route, no infrastructure that can replace the strait. If it closes, the oil simply stops. For 50 years, this geography has been the pressure point at which the petrodollar system is most vulnerable. American strategic planners have known this since Kissinger. Every US military posture in the Gulf, the Fifth Fleet based in Bahrain, the air bases in Qatar and the UAE, the carrier strike groups that rotate through the region, exists at its most fundamental level to ensure that the Strait of Hormuz stays open. Oil flows mean oil is priced in dollars. Oil priced in dollars means the world needs dollars. The world needing dollars means America can borrow cheaply, run deficits, project military power, and maintain the financial infrastructure that makes it the center of the global economy. Close the straits, even temporarily, and you don't just get an oil price spike, you get a question, a very loud, very public question, about whether the United States can actually fulfill the security guarantee that underpins the entire petrodollar arrangement. And once that question is asked loudly enough, the countries that have been accumulating dollars because they had to start asking whether they still have to. This is why Iran's strategic doctrine has, for decades, included the explicit threat to close the Strait of Hormuz, not because Iran believes it can win a conventional military conflict with the United States, but because Iran understands with remarkable clarity where the dollar's structural vulnerability actually lies. The connection between energy security and reserve currency status is not new. It has played out before, in different forms with remarkably consistent results. The British Empire's reserve currency dominance in the 19th and early 20th centuries rested, among other things, on British control of global shipping lanes. The Royal Navy did not just project military power, it guaranteed the security of the trade routes through which the world's commerce flowed. Coal-powered ships filled British ports. British merchant vessels dominated global trade. The pound sterling was trusted globally in part because British naval would be honored, British commercial arrangements would be honored, British trading would get through. When British naval supremacy declined, when American and German industrial and military power began to rival it, the confidence in British commercial guarantees also declined. The reserve currency transition that followed was not just a financial event, it was a reflection of a shift in who could actually guarantee the security of global commerce. The American version of this story substituted oil for coal and aircraft carriers for battleships. But the structural logic was identical. The dollar is trusted globally in part because American military power guarantees the energy supply chains on which the global economy depends. Remove that guarantee, or seriously call it into question, and you remove one of the structural pillars of dollar trust. There is a second historical precedent worth examining closely, the 1973 oil embargo itself. When OPEC cut oil supplies to the United States and its allies in 1973, it demonstrated something that had been theoretically understood but never empirically tested, that the energy security guarantee America was providing to its allies could be disrupted by actors the United States could not easily control or coerce. The immediate damage was economic. The longer-term consequence was a restructuring. The petrodollar deal that attempted to align the interests of the major oil producers with the continuation of dollar dominance. The current conflict did not emerge from a stable petrodollar system. It emerged from a system that was already under structural stress, a stress that had been building for years before the first shots were fired. The de-dollarization trend that Ray Dalio and others have been documenting accelerated sharply after 2022, when the United States and its allies froze roughly $300 billion in Russian central bank reserves held in Western financial institutions. The message was
İlk
unmistakable.
olarak
If
bu
you
iki
hold your
kavram
reserves in
arasındaki
dollars or
temel
in
farklara
dollar-denominated
odaklanalım.
assets in Western custody,
Sonra
those
konuyu daha
reserves can be
geniş bir
frozen or
perspektiften
confiscated
ele
if you fall out of
alabiliriz.
political favor with Washington. For countries that had been accumulating dollar reserves as a matter of financial necessity rather than political preference, China, India, Brazil, the Gulf states, much of the global south, this was a wake-up call. The dollar's status as a neutral reserve asset, accessible to all and subject to seizure by none, had been fundamentally compromised. The response was not a sudden flight from the dollar. Reserve currency transitions do not happen suddenly, but it was a sustained, deliberate diversification away from dollar exposure. Central banks bought gold at record rates. China accelerated its push to settle oil trade in yuan. The BRICS nations began constructing alternative payment infrastructure. Saudi Arabia, the kingdom that had made the original petrodollar deal in 1974, began publicly discussing pricing some oil sales in currencies other than the dollar. This was the landscape before the current conflict began. The petrodollar system was already experiencing the early stages of what Dahlia would describe as structural erosion, not collapse, not crisis, but the slow grinding away of the automatic dollar demand that had characterized the previous 50 years. The war in the Gulf has now introduced a new variable into this already stressed system, not just the economic disruption of higher oil prices and shipping uncertainty, but a direct real-time test of the security guarantee that underpins the entire arrangement. What does the historical record suggest about where this ends? There are three realistic paths, and they lead to very different places. The first is petrodollar stabilization. The United States succeeds militarily in the current conflict, secures the Strait of Hormuz, demonstrates that the security guarantee to Gulf producers is credible, and the petrodollar system continues roughly as before, perhaps with some modifications, perhaps with slightly reduced dollar share of oil settlement, but fundamentally intact. The dollar remains the dominant reserve currency. The dollar remains the dominant reserve currency. The de-dollarization trend decelerates. The crisis is absorbed. The American military capability in the Gulf remains overwhelming in conventional if the conflict is resolved in a way that clearly demonstrates its power projection and commitment to Gulf security. The credibility of the petrodollar arrangement may be reinforced rather than undermined, but it requires something that the current political environment in Washington has made difficult, sustained, credible commitment. Not just military victory in the immediate conflict, but a convincing signal that the United States will continue to underwrite Gulf security for the next generation at a time when American public opinion is increasingly skeptical of foreign military commitments, and when the fiscal position of the U.S. government is deteriorating. The second scenario is managed transition. The current conflict accelerates the de-dollarization trend that was already underway, leading to a gradual but irreversible shift in the global monetary system. The dollar retains reserve currency status but with a declining share. Other currencies, the yuan, the euro, a hypothetical BRICS currency, or some commodity-backed arrangement, take on greater roles in international settlement. This transition plays out over a decade or two, not overnight. Historically, this is the most common path for reserve currency decline. The British pound's decline from 1980 to roughly 1975 followed exactly this trajectory, a gradual, contested, painful erosion rather than a sudden collapse. For investors and policymakers, the managed transition is actually the most challenging scenario in some ways, because it is slow enough that denial is always possible, and because the optimal response, diversifying away from the declining currency before the transition is obvious, requires acting before the evidence is conclusive. The third scenario is a disorderly break, a combination of military escalation, oil supply disruption, and loss of confidence triggers a sudden repricing of dollar assets and a rapid capital flight from dollar-denominated reserves. This is the scenario that has occurred at the end of some previous reserve currency regimes, not the British pound, which declined slowly, but the Argentine peso, the Turkish lira, currencies of smaller economies whose reserve status depended on a single structural pillar that suddenly broke. There is a pattern in monetary history that deserves careful attention here, because it speaks directly to what we are watching unfold. Every reserve currency transition in the modern era has involved at some point a military intervention in Egypt, a retail event that served as the catalyst, the moment that made the structural weakness undeniable. The event itself did not cause the transition. The structural weakness was already there. But the event forced the question that everyone had been avoiding. For the British pound, the catalyst was the Suez Crisis of 1956. Britain and France launched a military intervention in Egypt to retake the Suez Canal after Nasser nationalized it. The United States, under Eisenhower, was not consulted and was furious. Washington threatened to sell its sterling reserves, which would have caused a catastrophic pound devaluation, unless Britain withdrew. Britain withdrew. The Suez Crisis did not end the pound's reserve currency status overnight, but it made undeniable something that had been structurally true since 1945, that Britain could not act as an independent great power without American permission, that the security guarantee behind the pound was ultimately American, not British, that sterling's continued reserve status depended on British subordination to American strategic priorities. Once that reality was visible, the pound's decline accelerated, not because of Suez itself, but because Suez itself would become the current situation in the Gulf is in important structural ways the mirror image of Suez. The question being asked, not loudly yet, but in the reserve management departments of central banks and in the quiet conversations of Gulf finance ministries, is whether American security guarantees are still unconditional, whether the petrodollar arrangement made in 1974 is still operative, whether the United States can and will continue to guarantee the energy security of a region that has supplied global oil markets for 50 years. If the answer to those questions starts to shift, if the perception of American reliability in the Gulf begins to erode, the monetary implications will lag the geopolitical shift by years. For ordinary people trying to preserve and grow their wealth through a period of monetary and geopolitical transition, the historical record offers specific and actionable guidance. The first lesson is that energy price shocks transmit to every corner of the real economy with a speed and breadth that no other commodity can match. The 1973 oil embargo didn't just raise gas prices, it triggered a decade of inflation, economic stagnation, and financial market turbulence that destroyed the purchasing power of conventional savings accounts. The people who survived that decade financially were the ones who held assets that preserved purchasing power in inflationary environments, real assets, commodities, equities, and energy-producing companies, and of course gold, which rose from $35 per ounce in 1971 to over $800 per ounce by 1980. The second lesson is that monetary transitions, even slow ones, create enormous winners and enormous losers. The winners are consistently those who understood the transition while it was still theoretical, who diversified away from the declining currency before the evidence was conclusive. The losers are consistently those who waited for certainty, who trustingly those who are consistently those who waited for certainty, who trustingly those who waited for their entire adult lives. The third lesson is geographic. Reserve currency transitions are not just about currencies, they are about the global distribution of economic power. As the center of gravity shifts, as the countries that represent the future of global growth accumulate influence and demand a monetary system that reflects their weight, the investment opportunities shift with it. The British investors who allocated capital to American markets in the 1920s and 1930s, even as the British Empire was declining, were positioned for the century that followed. The parallel question for today's investors writes itself. The Strait of Hormuz is 21 miles wide. The petrodollar system that flows through it is 50 years old. And right now both are under pressure that they have not faced before. This is not a crisis that arrived without warning. The structural weaknesses, the debt burden, the de-dollarization trend, the declining confidence in American security guarantees were visible for years before the first shots were fired. What the current conflict has done is force the question from the theoretical to the empirical. Not, could this happen? But is this happening? History says the answer will not be a single dramatic event. It will be a series of data points that accumulate slowly and then suddenly central bank reserve composition shifting by a few percentage points. Oil contracts settled in currencies other than the dollar. Gulf states quietly reducing their US Treasury holdings. In each data point would be explainable in isolation. Together, they would tell a story. The people who recognize the story early enough to act on it would be in a very different position than those who wait until it's obvious. The next video in this series examines something we haven't covered yet, the specific mechanisms of reserve currency transitions, the exact sequence of events, the timeline, the institutions that break first, drawn from the 3 best documented transitions in modern history. If you want to understand not just that the transition may be coming, but how it actually unfolds on the ground, that's the video you need. Subscribe. Because this is exactly the context that the news will never give you.